Hello, traders. It's 8 a.m. Chicago time on Tuesday, the 21st of July, 2020. This is episode number 1801. Thanks for joining me today. Looks like I'm getting some dropped frames here. I'm getting an alert from the broadcast software. Let me know if I'm cutting out. Not sure what I can do about it, but I may be able to just finish quickly and upload a clean stream. Derivatives trading is not suitable for all investors. Past performance is not necessarily indicative of future results. This morning, risk on as the market responds to good news out of Europe. The main drivers today, the main driver today really is, as anticipated, the EU agrees on a $1.82 trillion budget and virus recovery package. EU leaders agree early Tuesday on a groundbreaking plan to jointly borrow 750 billion euros to respond to the coronavirus pandemic, which has killed 135,000 around the block and sent economies across the continent into a tailspin. This is the big news here this morning. Um, what could be? All right. I'm going to make this a quick one. So overall, risk on sentiment across the board. The crude oil has taken a pop higher. September crude's trading 42.20 up $1.28 or 3.13%. The DAX is higher. And gold is higher as the market anticipates inflation there. Uh, the gold is at $1,840.70. Not too surprised there. The Russell's higher, 18 points or 1.24%. The Euro Stoxx is expected. The S&P is up 22.25. The S&P has traded up to the gap mid from the large coronavirus gap of February 24th. The Dow's up 175 points. The laggard today is the dollar. The dollar has lost quite a bit. Currently down 17 and a half cents, trading at $95.59 and a half cents or 0.18%. The Bund is down 9 cents. The bonds are down a tick, and the Treasury notes are down a small tick. So that's where we stand this morning. In terms of what was released overnight, there was a lot coming across. The U.S. coronavirus cases rise at the slowest pace in a week, which gave us a bit of a boost overnight. But also, the President Trump, is working with the Conservative Party, the leaders in the Senate, the GOP, and they remain divided about the key pieces of the virus relief bill that he would like to have released, obviously before the election, as it helps him. But at the same time, the president is sending troops to or federal agents to various states um, to enforce order, causing some friction there. I don't think that's going to impact the market, but the main news today is the coronavirus bill that's expected, or package that's expected to come out uh, from the U.S. It looks like it is stalling, but the Eurozone has managed to get its package approved after a few days of conversations here of negotiations. So that's what we're dealing with today. In terms of the calendar, we did get some numbers this morning out of the U.S. Out of the U.S., we got Chicago, a Fed National Activity Index, and others, but really today has no real high impact releases. I want to remind everyone that API crude stocks are due at 4:30 Eastern. 4:30 Eastern after the close. So that's where we stand today. Let's shift gears real quick into what was expected yesterday versus what we got. Yesterday, as you recall, we were opening inside of Friday's value, just above the overnight range. And the expectation is for the market to take a dip down into 32. 32.11, 32.10, and then rally with a pause potentially at with some encumbrance potentially at the 23 and then 29.30 area before it starts to push through the last week's high, which was I believe 29.75. So this is scenario one, a pullback and then a strong push higher. Here's what actually happened yesterday. There it is. We ended up pushing to 32.05 and a quarter, which has been a multi-day level, test level. That's why we have this stock zone right here. We push down into it, a nice impulse down, pulls back to mid and VWAP very, very nicely, and then turns over, but it's unable to get a continuation. And so as that happens, as we experience lack of continuation after an impulse down, we've got a situation, a clear situation where the market is likely to make an explosive move. And it did. It pushed a strong rotation from about 32.0850 to 32.2950. And all of it just in one fell swoop. And then remember the 2950, as I had mentioned, was expected to be an area of fight right up here. It's this particular area right here where I drew a bunch of zigzags. And that's where we ended up going at first, fighting this 29.50.30 back to 22. Remember, initially the 22 was expected to give us a bit of a fight, and it did right at the open, and it did again. It acted as support later, and then it finally releases to the upside. Yesterday was relatively, in my opinion, relatively straightforward in terms of how the auction was operating. Again, we got a serrated kind of saw type of profile. We see that yesterday we had some pretty active price discovery. The volume was in line with what we would consider to be normal, and we pushed into the gap zone. This gray bar right up here outlines a gap zone from the 24th of February. That's the action yesterday. Overall, and by the way, this was a fantastic setup right here. If you look at the delta in this push, as the market pounded on the bids, price did not give up any room at all at the IB high, and that's part of what fueled this explosive move up. Just a beautiful setup. Those are rare to see. When we see that delta is being hammered and price not moving, expect a trap there and expect a quick push and some lifting, some stop market orders to ensue as algos react to other computer activities and end up failing and having to cover. This was a really nice push up right here. And so we end up putting a high in at 32.50, the mid-century figure, and carrying that forward into today. So that was yesterday. What we just looked at was yesterday's action. This is RTH right here. It's shaded in dark gray. We open back up and then immediately take a quick push higher as the European news started to come out, and then we hold above the mid VWAP, and then finally we get the European markets opening and immediately buying it up. At that point, the news was confirmed, and we have rallied since. And so what we ended up yesterday with the overnight session with is let me turn this off. We ended up with a short covering profile, a P-shaped profile. The market has pushed quite a bit and has balanced at the top end of the range, pushing to 32.73 with with the gap zone mid from February 24th. Remember, this is the key gap zone that was this was the key gap zone that was formed when the coronavirus news first came out. This was a big gap and run area from February 24th. This was kind of like the early shot across the bow for the market, and then the shutdowns started coming in early March, the first or second week of March. So we've taken back the overnight session is taking back almost exactly the gap mid and has stalled right here with a point of control at the upper end of the range at 3267.75, and the delta being positive. Inventory is long, and currently it seems like the 50 to 56 area is the area to watch for continuation, or does the market come back as a result of the of a news-based event? So that's where we stand in terms of what we've got um, for order flow. The overnight session has been pretty straightforward. There's not been all that much in terms of order flow to talk about, to characterize here. We do have some liquidity up above the high at 74 to 76 or so. That's been there a while. This gap mid area has had liquidity for a long time, for the entire session, and you could see that there were some collisions here that resulted in a rejection of that price. Liquidity held, and that marked the high of day. That's 32.73 getting lifted and unable, and then basically buyers running out. Now they're rotating down, and we could see that the current liquidity down here at 59 through 63 is quite fresh. You can see it only showed up here a short while ago. So underneath that, 3250 is as expected. 3250 being around yesterday's high and the mid-century figure. We expect that liquidity to remain in place. So really, when I move out, this is what we've got. We've got the 22 to 25. We've got the 3300 century figure. We've got the 75.76, and we've got the 50 below us. Those are the key liquidity areas, liquidity pools that are available for today's session. And if you look at my cloud notes column, this is I transpose the key areas on. Look at how crowded this area is. We've got a gap zone that continues to run for a while. And then we are basically within earshot of the all-time high now. It would only take two full first standard deviation rotations up to get us well within the all-time high. Believe it or not, despite the fact that we have high unemployment and all that stuff, we are actually very close to the high. And as you already know, the Nasdaq's already made new all-time highs, trading up above. I think the Nasdaq had a high of around just under 11,060 this morning. And so remember, there's a disconnect between what the macro picture is, the global macro, blah blah blah, and what the market is doing, right? The market doesn't necessarily have to represent what the global macro picture is. We're not fundamental traders. But it's interesting to note that we are actually getting pretty close to the 3,300, and the all-time high is around 3373 or 3378. So we're very, very close. And on any given day, we can have a one standard deviation move of approximately 50 points. So that's only a couple of days worth of range for us to cover that. Anyway, just remember, below us 3250 to 48, above us 73 to 75, 76, above that 3300, below that 3222 to 25. These are the key liquidity areas above and below us. Now let's take a look at what's expected for today in our planning segment. So what are we looking for today here? We are in price discovery mode. Again, a very serrated or a very choppy profile from yesterday is an indication that the market is in a price discovery stance. And price discovery continues until we find balance. In other words, the market auctions high enough to find the opposing force, to find sellers, and then it starts to rotate. And then once it finds balance and starts to rotate, it makes an attempt. Generally, the general course of play is it makes an attempt in that same direction. If it's confronted with a flow of sellers, then it's likely to rotate and retest weak structures. Trend day, make weak structures. Yesterday had a slew of singles down in the 32, 39.50. I don't remember. Let me look at my levels list here. 32, 39.50, 32, 32.75, 32.21 and a quarter were all created yesterday as single prints, and those become key areas to fill and test on a rotation down. So it might have already found its sellers up here as we have the point of control and balance, but I doubt it. And given that it's the overnight session, I'm not quite going to lean on that too hard, that idea too hard. We're opening in a gap. So gap rules applied this morning. I'm expecting an open auction out of range that is likely to test higher early into 67.75 as more of the news is absorbed. I'm looking for an impulse down that brings us down into the 32.56 area, potentially close to yesterday's high of 50.50. I'm expecting a gap to remain open. It is Tuesday. Usually a reversal or very often a reversal or at least a high volatility day. And then I'm looking for it to creep higher as we work ourselves through the gap zone range. Remember, we've already hit the gap zone mid in the overnight session. That's what I'm looking for. I'm looking for the market to be a little bit responsive today. News-driven, news-driven trading this morning, and the expectation is it's likely to test down. And you know what? I don't like imposing words like should, has to, must, needs. Those aren't words that we should use in trading, in my opinion. They set up the wrong expectation, but the market has an easier time facilitating price discovery higher or rallying again by rebalancing, recalibrating, and testing for sellers below, advertising for more motivated buyers as price moves down. And so the expectation is it's likely to move down before it moves up. The secondary is an open auction that rebalances quite early. So the overnight inventory is long, mostly expecting it to rebalance in the overnight session. So the full session mid is right here in the 32.56 area, expecting it to get tangled here. And then I'm looking for an impulse back to the overnight point of control stat and then consolidate for a fair amount of the session and then finally break higher and start to grind higher as well. Because we are in that's quite a two there. Because we are in a gap zone, I'm going to push for an open test drive down. This is a drive that pushes, gets into the prior day's range, into the 50, potentially down to 46, 47, and then bounces back up in a V bottom and then finishes somewhere in between. That is the third scenario. If I see that we have a push higher and then size comes in and we get an impulse down. Now remember, I can sit here and do all the homework and planning and all this stuff. And all it is it's, pardon the term, kind of like mental masturbation. If all I'm doing is just responding with a scalp, with like a 5-point scalp. The goal of these lines is to have a plan, come in with a plan and an expectation, and to identify potential areas of response. That's what these squiggles are, the potential areas of response, so we can hold through those areas so we can achieve, 5R, 6R, 10R returns on our risk versus watching, fading a move that looks exhausted and then catching a 4-point rotation or 5-point rotation and then saying, I'm done for the day. That's not a sustainable way to trade. It's impressive to watch day in and day out, or to have happen day in day out. That's how I used to trade. I used to be a high volume scalper, and I did that, uh, you know, 300-400 times a day, and that was my day. But we're looking for more structure here. We're looking to be compensated for the risk that we take, and that's really what these scenarios are for. So again, the idea is we test up from below. We have the point of control above us, the VWAP and mid below us. Expect higher, and then let go with an impulse down on the first scenario, and then test towards, but not quite to, yesterday's high before we find prices low enough to begin the next run up. We did have a trend day. We generally don't follow a trend day with a trend day. There's a statistic for that. It's for that happening. It's approximately 13% historically that we have two well-identified trend days in a row. It's a low probability play, and this is why I'm looking for a dip initially. This is a probabilistic expectation, not a gut feeling. Gut feelings don't have a place in trading. Good luck today, and I'll catch you tomorrow morning. Take care.